your buyers just discovered they're 5,000 short for closing and the closing is scheduled for next week. Oh crap, right? I'm Ella Gurfinkel, and after rescuing hundreds of deals from last-minute closing cost shortfalls, I'm sharing the exact strategies that can save your transaction when buyers come on short at the closing table. Thing one that we look at is how to restructure seller concessions at the last minute. Unfortunate? Yes. Does it happen? Also yes. So being in the same boat, trying to rescue the deal, this is what we look at. When buyer discovers they're short on funds, renegotiating the seller concessions is often the quickest solution. The approach, however, is not so much that we're asking for more money out of the seller. We're talking about framing the request as a solution that keeps the deal on track in the following way. Here is a possible script. We're excited to close next week as scheduled. Seriously, we are. However, we've discovered a shortfall in the buyer's closing funds due to, and the reason has to be very specific. It's usually something the buyer could not foresee. As an example, higher than expected property taxes or property insurance requirements. And we all know right now the insurance is a sore spot. So really, we are running into situations like this right and left right now. So rather than delay closing or risk the deal falling through, my clients are requesting an additional X number of dollars in seller concessions, and they're willing to fill in the blanks, offer something in return. So to make this work for all parties, what can we offer in return? Slightly higher purchase price to offset the additional concession? ? Removal of contingencies or repair requests? Another ? Faster closing timeline, perhaps? ? As is acceptance of any outstanding inspection items. So here is an example of what we just had to deal with, where the buyers were about $4,200 short at closing due to higher than expected homeowners insurance. Yes, you guessed it correct. We're talking about California. We approached the seller with a request to increase the concessions from $5,000 to $9,200. So 5 plus 4,200 equals $9,200 in exchange for increasing the purchase price by $4,000. The seller agreed because they were still netting approximately the same amount, and we were still able to close on time, and kicker being the property actually appraised a little higher than the contract, so we had that room to play. Because here are two kickers here. Either the property has to appraise slightly higher to roll up the closing costs, or this renegotiation needs to happen before the appraiser goes out to inspect the property and to produce the appraisal report. The key here is making this request as early in the game as possible, or as soon as that shortfall is uncovered, to allow the time for the contract amendments and or possibly appraisal changes to occur. The next option is lender credit that trades rate for closing cost relief. In quotes. When seller concessions aren't an option, restructuring the loan to generate lender credit can save the day. Now, how does it work? The buyer accepts a slightly higher interest rate in exchange for the lender credit towards the closing costs. So typical trade-off works as follows. About an eighth in a higher rate gives approximately 0.5% of loan amount in buyer credit from the lender. A 0.25% higher rate equals approximately 1% of loan amount in credits towards the buyer's closing costs from the lender. And so on. We can go to 3/8 higher rate, translates to maybe about 1.5% of loan amount in credits. This is not an exact relationship. It does change as the markets shift and the rates shift, but this is your general idea of how the lender credit works. So for example, $400K loan, increase the rate from 6.75 to 7%. Quarter increase in the rate would generate about $4,000 in lender credits. So yes, it does increase the monthly payment, and we're looking at about $60 increase, but it solves the immediate cash shortfall. The refinance conversation that follows using the strategy, for me, I always discuss the future refinancing opportunities with the buyer and explain that once the rates drop, they've built some equity so we can refinance to a lower rate, making this a short-term solution for their immediate cash flow problem. Again, I'm not guaranteeing that the rates will come down. I don't know when the rates will come down, but There is always a refinance as a backup option later in the game. It's still better than walking away from the property because there will be equity built from the time of purchase to the time when they're ready to refinance. Timeline considerations. The rate change will require not only a new loan estimate, but potentially a new 3-day waiting period on the closing disclosure if it has been issued, because if the APR increases by more than 0.125%, we are required federally. It's not just something we want to do. Please trust me when I say that. It is absolutely not something we want to do, but federally, we are required to redisclose, and there is a new 3-day waiting period when it comes to the CD, the closing disclosure. So it is critical to make these decisions at least 4 to 5 business days before the scheduled closing, so we're not going to fall out of the closing timeline because we're now upping the rate, affecting the APR, and now a new 3-day waiting period is imposed by the feds. Gift funds is a solution to the money shortfall. Unfortunately, yes, that does send the buyer scrambling, looking for additional funds from family, but a family gift is a potential and a very common solution for the closing cost shortfalls. However, it requires proper documentation. As a matter of fact, let me restate that. Gift funds require very specific documentation and a very specific way or yellow brick road to follow, because otherwise you're creating more issues than solutions. The proper gift process. Obtain a gift letter, have it signed by the donor. It has to state the relationship to the borrower. It has to show the gift amount. It has to show the property address. It has to contain a statement that no repayment is expected, and document the source of funds. And this is where things go awry, unfortunately. That's why I say follow the yellow brick road. Now, this is something that is very important, and it's a very common mistake to avoid when it comes to gift money. Cash gifts. We do not deal in cash on the mortgage side. And since we're talking about the mortgage side, the cash gifts are not acceptable. Undocumented transfers between accounts are not acceptable. Gifts from individuals not related by blood, marriage, legal guardianship, and documented long-term friendship relationships are not acceptable. Missing or incomplete gift letters are not acceptable. I'm not trying to go negative here. I'm just telling you what's not going to fly so that your buyers are absolutely prepared. So, for example, I was working with a buyer who was $7,500 short for closing. That's a sizable shortfall. Let's not get into the story behind it, but that happened. Their parents agreed to gift the funds, but initially provided a personal check without documentation. That by itself could have delayed closing by about 10 days for funds to clear and show us the paper trail behind them. Instead, we had the parents stop the payment on the check, wire the money directly to the title company, and with proper gift documentation, it allowed us to proceed to closing on schedule. Down payment assistance programs with fast approval timelines is something else that we can also consider. And believe it or not, that's actually something that I've had to use more than a few times over my career, where we had to switch gears mid-flight from normal, in quotes, transaction to a down payment assist because something happened and the buyer no longer had the money or no longer had enough money. So no judgment here. My job is to fix it and keep transaction moving forward. That's all I'm here for. I'm not here to judge the buyer. I may not be happy about it, but I still have to figure out a solution. So there are some fast-track DPA options that we can look at where the underwriting is done in-house so that we're not losing time. Another way to look at it is employer assistance programs. Some large employers do offer closing cost assistance or down payment assistance that can be approved in 3 to 5 business days, or conversely, pulling some money fast from a 401k. That's another option that can be done. Now, community grants is something that may potentially work only if they work fast, because some require that the buyer is already in contract. Some require actual approval by the lender. It may take time, and some may just not even have the money available. So tread lightly on those. The key here is working with the lender who is experienced with rolling with the punches, really, or with these programs and options that can expedite the process of covering the shortfall when the buyer comes up short at the 11th hour. Here's some more creative solutions for last-minute shortfalls. When traditional methods aren't available, or anything I've talked about in the prior few minutes, These creative approaches can also help save deals, and I have a history with them. So let's talk about them. Prorated expense adjustments. Working with the title company to adjust the prepaid expenses, initial escrow deposits is one of them. Adjusting the first payment date to reduce the initial escrow requirements or to reduce the cash to close based on the days left in the month, and the first payment date to be set out or set forward, closing at the end of the month or closing at the beginning of the month, which also adjusts how many days of prepaids we have to worry about. All of these adjustments can sometimes reduce closing costs by between a few $100s all the way to like $3,000. So it's pretty significant actually. Are your buyers facing a last-minute closing cost shortfall? Please don't panic. Don't let the deal fall apart. Send me the details of your situation, and I will help you identify the fastest, most practical solution to close on time. I've rescued hundreds of deals from the brink of collapse due to funding shortfalls and many other reasons to boot, and I can likely save yours too. Text Closing Rescue to the number on your screen, and I'll respond within 2 hours during business hours with strategies tailored to your specific buyer situation. Thank you so much for watching. I'll see you in the next one.